Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Imagine an investment so secure that even during economic hurricanes, it remains a rock solid safe harbor. Today, we're diving deep into the world of U.S. government bonds, the financial instrument that's part safety net, part strategic opportunity.
So, when people say safe investment, what exactly makes government bonds different from just putting money in a savings account? I mean, aren't they basically the same thing?
Great question. What most people don't realize is that government bonds aren't just a passive parking spot for money. They're sophisticated financial tools that can protect your wealth, generate predictable income, and even serve as a strategic hedge against inflation. In this episode, we'll break down exactly how these securities work and why sophisticated investors see them as much more than just a safe option.
Let's dive into the specifics of how these bonds actually work and the key factors to consider when incorporating them into an investment strategy.
Absolutely. At their core, government bonds are fairly straightforward. You're essentially lending money to the U.S. Treasury, and in return, they promise to pay you back with interest. However, there are several distinct types of government bonds, each with its own characteristics and benefits.
I've heard terms like treasury bills, notes, bonds, tips, and it gets a bit confusing. Can you break down the main differences between them?
Certainly. The key distinctions come down to maturity dates and whether they offer inflation protection. For example, Treasury bills are short-term securities maturing in 1 year or less. They're sold at a discount from face value. Treasury notes have maturity dates from 2 to 10 years. They pay fixed interest every 6 months and face value at maturity. Treasury bonds work similarly but have longer 20 to 30-year maturities. TIPS, or Treasury inflation-protected securities, have 5, 10, or 30-year maturities, but their principal is adjusted based on changes in the consumer price index. So they directly hedge inflation risk.
This is a great segue into a crucial consideration for bond investing, the relationship between interest rates, inflation, and bond values. When rates go up, bond prices tend to fall, and vice versa. TIPS directly account for inflation, while other bonds are more indirectly affected.
So, if I'm looking at government bonds for my portfolio, it sounds like a mix of different maturities and types could help balance things out over time. Kind of like not putting all your eggs in one basket.
That's a smart way to think about it. Laddering maturities and diversifying between nominal bonds and TIPS allows you to manage interest rate risk, ensure steady cash flow, and hedge against inflation over different time horizons. Of course, the exact mix depends on your specific goals and situation.
That's an important point. While government bonds are generally less risky than stocks, there isn't a one-size-fits-all approach. So far, we explored the different types of U.S. government bonds and how their unique characteristics can serve various investment goals. Now let's take a closer look at how these securities fit into the bigger picture of portfolio construction and risk management.
Absolutely. While the safety and predictability of government bonds make them valuable in any market environment, they become especially important as part of a well-diversified investment strategy.
So, when you say well diversified, you mean holding a mix of different asset classes, right? Like stocks, bonds, maybe some real estate or commodities?
Exactly. Each asset class tends to behave differently depending on economic conditions. For example, when the economy is struggling and stock prices are falling, investors often flock to the relative stability of government bonds. This flight to safety can actually cause bond prices to rise, counterbalancing losses in other parts of a portfolio.
That's a great point about the interplay between asset classes. It's also worth noting that within the government bond universe itself, diversification is key. As we discussed earlier, varying maturities and bond types can help manage interest rate and inflation risks.
I think I'm starting to see how the pieces fit together. So if I'm building a portfolio, I might start with a core of government bonds for stability and then layer in other assets based on my goals and timeline. And then I can further fine-tune my bond holdings as needed.
You've got the right idea. The proportion of government bonds relative to other assets depends heavily on an individual's risk tolerance and investment horizon. Generally, the closer you are to needing your money, the more you may want to shift towards bonds to protect your capital.
And that's where having a clear understanding of your financial objectives is so critical. Regularly revisiting your asset allocation as your life circumstances change can help keep you on track.
Makes sense. So it's not just a set it and forget it approach. Staying engaged and making adjustments seem important, especially in times of market volatility.
Definitely. While government bonds can provide a valuable buffer against volatility, they're not a panacea. Monitoring broad economic trends, staying attuned to your evolving needs, and working with a trusted financial advisor can all help ensure your government bond holdings continue to serve their intended purpose within your overall investment plan.
Well said. Now, let's dive a bit deeper into the specific strategies investors might employ when allocating to these securities.
Absolutely. One common approach is what's known as a laddering strategy. This involves building a portfolio of bonds with staggered maturities, for example, holding equal amounts of bonds maturing in 1, 3, 5, and 10 years.
Interesting. So by spreading out the maturities, you're not overly exposed to interest rate changes at any single point in time, right?
Exactly. If rates rise, you'll have bonds maturing soon that can be reinvested at the higher rates, and if rates fall, you'll still have some higher-yielding bonds locked in for longer. It's a way to balance risk and return potential.
That makes sense. What about factoring in inflation? I know that's a big concern for many bond investors.
Great point. For investors particularly concerned about inflation eroding their purchasing power over time, Treasury inflation-protected securities, or TIPS, can be a valuable tool. The principal value of TIPS adjusts upward with inflation, helping to preserve real returns.
So with TIPS, both the principal and the interest payments increase as inflation rises.
That's correct. The inflation protection is based on changes in the consumer price index. So in an inflationary environment, TIPS can help maintain your portfolio's buying power.
It's worth noting, though, that TIPS typically offer lower initial yields than comparable conventional Treasury bonds. So there's a bit of a trade-off there.
Right? So I guess it comes down to your outlook for inflation and your specific risk tolerance. If you think inflation will be high, the lower initial yield might be worth it for the protection.
Definitely. And many investors choose to hold both, combining the inflation protection of TIPS with the higher yield potential of nominal bonds to balance their inflation risk.
That's a great example of how diversification within the bond allocation itself can be beneficial. By understanding the unique characteristics and roles of different bond types, investors can construct a portfolio that's tailored to their individual needs.
This has been really helpful in seeing how the different pieces can work together. I feel like I have a clearer picture now of not just what the different government bond options are, but how they can be strategically combined.
Fantastic. And we're just scratching the surface here. Let's turn our attention to the impact of the broader interest rate environment.
Absolutely. Changes in prevailing interest rates can significantly influence the performance of government bonds. When rates rise, prices of existing bonds generally decline as newer issues offer higher yields. Conversely, falling rates can create appreciation opportunities for bondholders.
So it's kind of an inverse relationship. Bond prices move opposite to interest rates, right?
Exactly. The longer the maturity of the bond, the more sensitive its price is to rate changes. That's why you'll see Treasury bills, with their short maturities, maintaining price stability, while 30-year Treasury bonds experience greater fluctuations.
This is where the concept of duration comes into play, correct?
Yes, duration is a measure of a bond's sensitivity to interest rate movements. Mathematically, it represents the weighted average of the times until a bond's cash flows are received. The higher the duration, the more a bond's price will change for a given shift in rates.
And this is different from just looking at the maturity date because it also accounts for the timing of coupon payments along the way, right?
That's a great point. Duration provides a more comprehensive view of interest rate risk than maturity alone. It's a key metric for bond portfolio managers in assessing their exposure.
So, for investors concerned about the potential for rising rates, focusing on shorter duration bonds could help mitigate that risk.
Definitely. Shortening portfolio duration is a common tactic when rates are expected to climb. This might involve shifting allocations toward T-bills or short-term notes. On the other hand, if rates are anticipated to fall, extending duration could amplify price gains.
It seems like having a view on the direction of interest rates is pretty important for managing a bond portfolio effectively.
It certainly is. Many investors and managers closely follow economic indicators, Federal Reserve policy, and market sentiment to form their interest rate outlooks. While predicting rate moves is notoriously difficult, understanding their impact is crucial.
And of course, interest rate risk is just one of many factors bond investors must navigate. Credit risk, inflation, liquidity needs, they all play into the equation.
Wow, there's certainly a lot to consider. I guess that's why having a clear investment strategy and risk tolerance in mind is so important to help guide these decisions.
Absolutely. And as with all investments, diversification is key. Holding a mix of maturities, credit qualities, and bond types can help smooth out the impacts of market movements on a portfolio.
That's right. A well-diversified bond allocation, aligned with an investor's goals and constraints, is the foundation of effective fixed-income investing, actively managing risk while seeking to optimize income and total return.
This has been a fascinating look at some of the dynamics at play in the government bond market. As we wrap up, what would you say is the key takeaway for our listeners?
I think the main message is that while government bonds can play a vital role in a portfolio, they're not necessarily the static, set-it-and-forget-it instruments some might perceive. There are many levers investors can pull to adapt to changing market conditions, from duration positioning to inflation protection to diversification. The key is understanding the characteristics of these securities and employing them thoughtfully within the context of your broader financial plan.
Sage advice? Let's dive a bit deeper into the specific types of Treasury securities and how they can be strategically incorporated into investment portfolios.
Absolutely. The U.S. Treasury offers a range of investment options to meet different objectives, from short-term cash management to long-term income generation. The three primary types are Treasury bills, Treasury notes, and Treasury bonds.
I've heard those terms before, but I'm not entirely clear on the differences. Can you break down what sets them apart?
Sure. Treasury bills or T-bills are short-term securities with maturities of 1 year or less. They're sold at a discount to face value, and the difference represents the interest earned. T-bills are often used for short-term cash needs or as a parking spot for funds.
So with T-bills, you don't receive regular interest payments, right? The return comes from that initial discount?
Exactly. You buy a T-bill for less than its face value, and upon maturity you receive the full face amount. The difference is your interest earned.
Got it. So what about Treasury notes? How are they different?
Treasury notes, or T-notes, are intermediate-term securities with maturities of 2, 3, 5, 7, or 10 years. Unlike T-bills, T-notes pay interest semi-annually, making them popular for investors seeking regular income without ultra-long-term commitments.
And that semi-annual interest is based on a fixed coupon rate, determined at issuance, correct?
Right. The coupon rate is set when the T-note is first auctioned and remains fixed throughout its life. The price of the note can fluctuate in the secondary market, but the coupon payments stay the same.
That predictability of income seems like a key advantage. What are some other benefits of T-notes?
T-notes offer several attractive features. In addition to reliable semi-annual income, they provide moderate duration risk compared to longer-term bonds, excellent liquidity in the secondary markets, and favorable tax treatment at the state and local levels in most cases.
That brings us to the third main type, Treasury bonds, or T-bonds. These are the longest-term option, right?
Yes, T-bonds represent the long end of the Treasury yield curve, with maturities of 20 or 30 years. Like T notes, they pay interest semi-annually, but their longer duration makes them more sensitive to interest rate changes.
So it seems like T-bonds would be more geared toward investors with extended time horizons who can ride out some of those price fluctuations.
Absolutely. T-bonds can be an important component of income-focused portfolios with long-term liabilities, like pension funds or retirement accounts. The higher yields they offer compared to shorter-term securities can help offset their greater price volatility over time.
This has been a great overview of the Treasury Security spectrum. As we think about incorporating these investments, what are some key principles to keep in mind?
Effective government bond investing requires careful consideration of individual objectives, time horizons, and risk tolerance. It's also important to monitor market conditions and periodically rebalance portfolios to maintain strategic asset allocation.
So it's not just a set it and forget it approach. It sounds like staying engaged and making tactical adjustments when needed is important.
That's a crucial observation. While government bonds can play a vital role as a portfolio stabilizer, they still require thoughtful oversight and management to optimize their benefits.
Well said. By aligning government bond investments with individual needs, maintaining a disciplined strategy, and adapting to evolving market dynamics, investors can effectively harness these securities to enhance portfolio resilience and support long-term financial goals.
To recap, we explored the key types of U.S. Treasury securities, T-bills, T-notes, and T-bonds, and how their unique characteristics can be matched with different investment objectives. We also highlighted the importance of active portfolio management and customized strategy in effectively incorporating government bonds. Now that we've covered the different types of Treasury securities, I think it would be valuable to explore how investors can effectively incorporate them into their portfolios.
Absolutely. The key is aligning your Treasury investments with your specific financial goals, risk tolerance, and time horizon. T-bills, T-notes, and T-bonds each have unique characteristics that make them suitable for different objectives.
That makes sense. So for someone focused on short-term cash management, T-bills could be a good fit, while an investor saving for retirement might lean more toward T-bonds for the higher yields.
Exactly. T-bills are great for parking cash you might need in the near future, while T-bonds can provide a reliable income stream for long-term goals. T-notes offer a balance for medium-term needs.
It's also important to remember that Treasury securities can play a valuable role in diversifying a portfolio and managing risk, right?
Definitely. Because Treasuries are backed by the U.S. government, they're considered one of the safest investments available. Including them in a portfolio can help offset the volatility of riskier assets like stocks.
So even if an investor has a long-term focus and high risk tolerance, it could still make sense to allocate some portion to treasuries as a stabilizing force.
Absolutely. The proportion will vary based on individual circumstances, but almost every investor can benefit from the stability and diversification treasuries provide.
Another factor to consider is the tax treatment of Treasury securities, particularly for state and local taxes.
That's a great point. While treasuries are subject to federal income tax, they're generally exempt from state and local taxes. This can make them especially attractive for investors in high-tax states.
So if I'm comparing a treasury investment to a corporate bond with a similar yield, the treasury might actually come out ahead on an after-tax basis.
Exactly. It's important to consider your effective after-tax yield when evaluating different investments. The tax exemption can give treasuries a significant advantage, especially for investors in upper tax brackets.
This has been a really helpful exploration of how investors can think strategically about incorporating treasuries into their portfolios. To recap, the key is aligning your treasury investments with your specific goals and risk profile, while also considering the diversification benefits and tax advantages they can provide.
Well said. By thoughtfully integrating treasuries into a broader investment strategy, investors can enhance the stability and resilience of their portfolios while still pursuing their long-term financial objectives.
This discussion has given me a much clearer sense of how to approach treasury investing in a purposeful way. I'm looking forward to applying these insights to my own portfolio.
That's great to hear. And as always, we recommend working with a financial professional to develop a tailored investment plan that aligns with your unique circumstances.
Absolutely. While the principles we've discussed provide a solid foundation, there's no substitute for the customized advice a knowledgeable advisor can offer based on your specific financial situation and goals. If you'd like personalized guidance, you can reach out to us at safesimplesound.com/contact.
We covered a lot of ground today, from the unique characteristics of different Treasury securities to the strategic role they can play in a diversified investment portfolio. But there is more to government bonds. Let's dive deeper into a unique category of treasuries designed for inflation protection: TIPS and I bonds.
Absolutely. Treasury Inflation Protected Securities, or TIPS, are a valuable tool for investors concerned about the erosive effects of inflation over time. As the name suggests, TIPS are specifically engineered to protect purchasing power.
That sounds really useful, especially for long-term investors. Can you explain how the inflation protection actually works with TIPS?
Sure. The principal value of TIPS adjusts based on changes in the Consumer Price Index, or CPI. So when inflation rises, the principal increases. The coupon rate is fixed, but because it's applied to the adjusted principal, the actual interest payments grow as well.
So, in a sense, TIPS provide a double layer of inflation protection, with both the principal and interest payments increasing to keep pace with rising prices.
Exactly. And at maturity, investors receive either the inflation-adjusted principal or the original principal, whichever is greater. So there's a built-in safeguard, even if there's a period of deflation.
That's a really compelling feature. Are there any limitations or trade-offs investors should be aware of with TIPS?
One important consideration is that TIPS typically offer lower initial yields compared to traditional nominal treasuries. Investors are essentially paying a premium for the inflation protection. TIPS are also sensitive to changes in real interest rates, so their prices can fluctuate in secondary markets.
So it's about weighing that upfront yield concession against the value of the long-term inflation hedge. For investors particularly concerned about purchasing power erosion, that trade-off may be well worth it.
That makes sense. Are TIPS the only option for inflation protection in the government bond space?
Another unique option is Series 1 savings bonds, or I bonds. Like TIPS, I bonds are designed to protect against inflation, but they have some distinct features.
What are some of the key differences between I bonds and TIPS?
I bonds are non-marketable securities, meaning they can't be bought or sold in secondary markets like TIPS can. They're also limited to a maximum purchase of $10,000 per year per person. The interest rate on I bonds combines a fixed rate and an inflation rate that adjusts twice a year.
So it sounds like I bonds could be an attractive option for individual investors looking for a more passive, set-it-and-forget-it approach to inflation protection, while TIPS offer more flexibility and liquidity.
That's a great summary. Of course, as with any investment decision, it's important to consider how inflation-protected securities fit into your overall portfolio strategy and align with your specific goals and risk tolerance.
Absolutely. While TIPS and I bonds can be powerful tools for preserving purchasing power, they should be viewed as part of a broader, diversified investment plan. Working with a financial advisor can help investors determine the appropriate role and allocation for these securities in their individual circumstances.
That's a great point about considering how inflation-protected securities fit into an overall portfolio strategy. Building on that, I think it would be valuable to explore some different approaches investors might take when implementing TIPS or I bonds.
Absolutely. When it comes to incorporating inflation-protected securities, investors generally fall into two camps: those who take a more conservative approach and those who employ a more aggressive strategy.
What would a conservative approach look like in this context?
Conservative investors prioritize capital preservation and risk management. They might focus on shorter duration TIPS to minimize interest rate risk, regularly reinvest maturing securities to maintain consistent exposure, and emphasize protecting purchasing power over maximizing yield.
So for risk-averse investors, it's about striking a balance between the inflation hedge and insulating the portfolio from excessive price volatility.
That makes sense. And on the flip side, what might a more aggressive strategy entail?
Investors comfortable with greater price fluctuations in pursuit of higher return potential might gravitate toward longer duration TIPS, which tend to offer higher yields but also carry more interest rate risk. They may also employ more active trading strategies to capitalize on market dislocations or interest rate shifts.
It's important to underscore that an aggressive approach doesn't negate the importance of diversification and risk management. Even for investors with higher risk tolerance, inflation-protected securities should be part of a broader asset allocation framework.
Definitely. What about portfolio allocation? How much should investors dedicate to inflation-protected securities?
There's no one-size-fits-all answer, as the appropriate allocation will depend on an individual's specific financial situation, goals, and risk profile. That said, many experts suggest allocating 5 to 15% of a fixed income portfolio to inflation-protected securities as a baseline.
And of course, that baseline should be adjusted based on factors like your investment time horizon, sensitivity to inflation risk, and other asset holdings. A financial advisor can be a valuable resource in tailoring an allocation to your specific needs.
That's helpful context. Shifting gears slightly, what about the tax implications of investing in government bonds like TIPS and I bonds?
Great question. One of the advantages of government bonds is their favorable tax treatment. The interest earned is exempt from state and local taxes, though it's still subject to federal income tax. TIPS and I bonds also offer some unique tax advantages.
That's right. With TIPS, investors can choose to pay taxes on the interest annually as it accrues or defer the tax liability until the bonds mature or are sold. This flexibility can be helpful in managing your tax situation over time.
And with I bonds, there are some additional benefits. If you use the proceeds from I bonds to pay for qualified higher education expenses, you may be able to exclude the interest from your taxable income entirely.
Wow, that education angle is compelling. Are there any other special tax considerations to keep in mind?
One thing to note is that while the favorable tax treatment of government bonds can enhance after-tax returns, it's important not to let the tax tail wag the investment dog, so to speak. Investors should still evaluate these securities based on their overall investment merits and suitability for their specific financial goals.
That's sage advice. As with any investment decision, it's about striking the right balance and maintaining a holistic perspective.
This has been incredibly informative. I feel like I have a much clearer understanding of how to approach inflation-protected securities within an overall investment strategy.
We've covered a lot of ground today, from the mechanics of TIPS and I bonds to strategic implementation considerations and tax implications. The key takeaways are to align your approach with your individual goals and risk tolerance. Consider these securities as part of a diversified fixed income allocation and stay attuned to the interplay between taxes and investment decisions. I'll underscore what's said earlier. Consulting with a financial professional can be immensely valuable in navigating these decisions and crafting a government bond strategy that works for your unique situation. If you'd like personalized guidance, you can reach out to us at safesimple.com/contact. I think it would be valuable to zoom out a bit and revisit the core theme we touched on at the beginning: the role of government bonds as a safe haven in modern investment portfolios. Could you share some high-level thoughts on that?
Absolutely. In times of market volatility and economic uncertainty, investors often seek out U.S. government bonds as a bastion of stability and predictability. The unconditional guarantee of the U.S. government, coupled with the relative safety and liquidity these securities provide, make them a go-to choice for risk-averse investors or those looking to balance riskier holdings.
That's a great point. Government bonds can act as a crucial ballast for a portfolio, helping to mitigate overall volatility and provide downside protection during market downturns.
So, in constructing a well-rounded investment strategy, it's not just about chasing the highest returns, but also ensuring you have some exposure to these more defensive plays.
Exactly. Think of it like building a sturdy house. You want a solid foundation to weather any storms that may come. Government bonds can help provide that base-level stability and risk management every portfolio needs. Then you can layer on other asset classes and investment strategies according to your specific goals and risk profile.
I love that analogy. It really drives home the importance of diversification and risk management.
Tying it all together, what would be your top pieces of advice for investors considering adding government bonds to their portfolios?
First and foremost, make sure any investment decisions are grounded in your individual financial situation and objectives. There's no one-size-fits-all approach, so it's crucial to tailor your strategy to your unique needs. Second, don't just view government bonds in isolation, but consider how they fit into your overall asset allocation. As we discussed, they can play a vital role in complementing riskier holdings and promoting balance. Finally, don't be afraid to consult with a financial professional who can provide guidance and help you navigate the complexities of the bond market. Their expertise can be invaluable in optimizing your government bond strategy.
Those are some really powerful takeaways to end on. Government bonds remain a core pillar of a balanced investment approach, offering a unique combination of safety, income generation, and risk management potential. By understanding the different types of government securities, their characteristics, and how they can be effectively deployed, investors can make more informed decisions and build resilient portfolios designed to weather market cycles. Thank you both for a truly fascinating and informative discussion. Any final thoughts before we close?
Just that, I have a newfound appreciation for the strategic role government bonds can play and feel much more equipped to evaluate how they might fit into my own investment plan. There's certainly a lot to consider, but this has been a masterclass in the key principles. Thank you.
With that, we'll wrap up today's deep dive on U.S. government bonds. Join us next time as we shift our focus to the world of corporate debt and explore how these securities can further diversify a fixed income portfolio. Until then, stay curious and invest wisely.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at savesimplesound.com. If you would like personalized guidance, you can reach out to us at savesimplesound.com/contact. Until next time, take care and bye for now.